Tata Motors reported its financials for Q4 FY25 and profits stand at rupees 8,470 crore, revenue at 1,19,000 crore. The EBITDA came in at 16,992 crore. Jaguar Land Rover reported revenues of 7.7 billion pounds and the EBITDA margins for JLR stood at 15.3%. The company reported a 10th consecutive profitable quarter. Free cash flows at JLR were 1.5 billion pounds for FY25. The company also managed to achieve its guidance of turning cash flow positive by the end of FY25. Tata Motors expects investments spent for JLR to remain at 18 billion pounds over a 5-year period, and this will be funded by operational cash flows. Joining us right now to discuss Tata Motors' overall performance in Q4 and also the outlook going forward is PB Balaji, the Chief Financial Officer of Tata Motors. Mr. Balaji, thank you very much for joining us. How would you describe the overall demand sentiment, the mood in the economy in India right now and globally?
Yeah. Firstly, thanks for having me on the show. Appreciate it. Overall demand situation as far as India is concerned is, I would say, is modest, is decent, not scorching. At the same time, neither is there any major concern at this point in time. So I would expect modest growth coming into this year. On the commercial vehicle business, I think the underlying fundamentals of the growth is very much intact, be it on freight rates, be it on interest rates, fuel prices. Overall, GDP growth in the industry economy is good. At the same time, even investment plan for the government also continues to remain strong. So all of them portend well for a decent growth. When does the cycle begin? When does the cycle, which part of the cycle we are in? Very difficult to predict. But medium to long term, no major concerns as far as the CV growth is concerned. On the passenger vehicle growth, I think we did have a lukewarm growth last year. Nothing much to talk about last year. And I would suspect that this year would be an year where it will be modest growth once again and gradually build back as the year progresses. So overall, I'm quite comfortable with the demand situation in India, and we should be in a position as Tata Motors to continue to do well in this market. For us, the reason to do well, if I split this into CV, PV once again, I think on the commercial vehicle side, we are doing quite well on the heavies, the passenger carriers, as well as the intermediate vehicles. Where we have not done a good job is the small commercial vehicles. And this is a year where we expect to fix those issues that were more front-end issues that we have. We intend to fix that this year. On the passenger vehicle side, I think our product launch cycle, we get the offensive from now on. We just had the Tiago relaunch happening. We just had the Altroz relaunch that just happened 2 days back. All that augurs well for the hatches segment, which is where we lost last year. And the SUV segment continues to do well for us. We grew well ahead of the market. And that is an area where we have the Harrier EV landing, the Punch MC mid-cycle refresh happening. And then we also have the Sierra happening later in the year. So there's enough to go for growth as far as the PV EV business is concerned as well. So overall, the India growth plan for next year for us is strong, and we intend to drive that hard.
Okay. I would also like to ask you about market share loss in the passenger vehicle segment. In fact, analyst reports this morning have expressed some caution and concern about continued market share loss in passenger vehicles. Would you like to weigh in on this concern and how the company is looking to address that?
I think for me, last year is a year of consolidation, 13.2% share. In many months, we were number 2 in the market. So it's not so much a market loss, share loss issue. It's more about how do we grow market share from here on. In that, there are 2 angles here. One is our product launches start from now on vis-a-vis competition, which was more last year. And at the same time, we also had a challenge with respect to our capacity available on our service network, which created some amount of challenges from a customer perspective. Both these are addressed. So we have an intensive product launch pipeline starting now. And we also have more or less fixed the service capacity issues that were there. And that should ensure that the customer sentiment on that goes up as well. Both these augur well in terms of delivering growth well ahead of the market. And we are quite confident of how we are stacking up as we enter the new year.
Right. Speaking about EVs, you have a 55% market share in the electric vehicle segment. Now, the launches by your peers has, of course, impacted the space. There are more players entering, and there are companies which have increased their sales numbers on a month-to-month basis as well. How do you see competition? Do you think your EV strategy needs some rethink right now?
Not really. We just need to execute that with speed. And let me tell you how we intend to go about doing that. The first focus of the EV business is to drive penetration of EVs in the overall portfolio. I am not focused on market share here. It is more about how do we grow this market sequentially. Last year, we had a fundamental issue with respect to the fleet segment getting into challenges because of FAME incentives going away, as well as some of the EV players, EV fleet players are having a few challenges. And this year, we intend to address that in terms of catering to a wider EV portfolio than what was there last year. So that is going to be an important aspect of fixing the bleeders first. Then in terms of the portfolio itself, we are the widest range portfolio in the market with Tiago at one end, and when the Harrier EV launches, that is the other end of it. And then we have a Sierra that's coming in as well. So this kind of a wide portfolio with multiple range offerings makes us cater to different customer segments well. And that is what we intend to leverage as we go forward. So with the product portfolio in a intensively expanded and ensuring that we fix the fleet segment, we believe the growth volumes will start coming up. Then we have a bigger issue to solve, which is basically how do we drive up penetration of EVs in the overall passenger vehicle segment. And for which I think there are two issues to fix. One is the charging network expansion. Last year we now have about 21,000 fast chargers in the country, and we want to continue to work with our charge point providers to ensure that we expand this further. And number two is range. And now we are seeing that more and more cars are coming even from our stable at greater than 400 kilometers range, and that is more or less going to remove the range anxiety from the customer segment as well. These two should help ensure that the EV penetration drives up as well. So we have a comprehensive plan in place, and it is our intention to execute this flawlessly so that we can drive up penetration of EVs in the overall portfolio.
Okay,
Market share of EVs in the overall, that's a less important issue. What is more important is to ensure that we drive up penetration.
Driving up penetration. And when you say that you want to increase the number of charging points all across the country, would there be any targets for FY26?
We haven't put it out there, but rest assured, this is priority number one for us on the EV side.
Okay. All right. Now, JLR, you've met your target of making the company cash positive by the end of FY25. How do you expect to perform on this parameter in FY26 and 27? Given the company's capex plans?
Yeah. There are two metrics that were critical to deliver last year. Actually three. One was delivering the revenue of about 29 billion, which we have done. Second was to deliver 8.5% EBIT, and we delivered that 8.513%. That is what the final number was, the third decimal point. And third is to ensure that we go net cash. I think all these targets, if you go back in Q2 when there was the aluminum issue that we faced, there was a lot of skepticism on whether we can pull it off. And here we are after 6 months confirming, yes, we have indeed delivered that. So one thing which we want to ensure in anything that we do is the say-do ratio has to be of a very high order. And from our perspective, what we are seeing now is in this kind of external environment that we are currently facing, which is a bit unclear. Because one is, of course, it's challenging. The other is also we are not clear what exactly how it plays out. Take the UK-US tariff, for instance. We welcome really the deal that has been done, which is now reducing tariffs from 25% to 10%. But it has gone up from 2.5 to 10, number one. Number two, even that reduction, we are not clear when does it become effective? Is it applicable for parts? Is it applicable retrospectively? So those are questions that are still out there, and we are hopeful to get clarity on that. Once we get clarity on that, it's our ability, then we'll be in a better position to predict what the numbers are going to be. Having said that, what we are distilling out of this situation is that there could be two impacts. One is your demand is likely to be impacted, particularly in the US, for which we need alternate sources of demand, number one. Number two, the tariffs are going to have a significant impact on your costs, and therefore, how are you going to ensure you manage the cost in that environment? So if I look at the first one, that is demand, what we have going in with is US is probably likely to be having a lower growth next year compared to what we had last year. And therefore, we need additional sources of growth. The first market that is looking very good for us is UK, and we would intend to accelerate that. Second is Europe is always is a very large market and a market that we are doing well, and it's a market that is starting to stir up, and therefore we would want to leverage that. China, which had been bleeding, is now, I think, is now stabilizing, at least for us, and therefore we would want to see how much we can build back on that front. And there's an overseas market that is doing very well for us, which is Middle East, India, etc. And there again, we should want to diversify our growth sources. So that is how we intend to play the demand side of it. On the cost side of it, I think, yes, tariffs are a cost. How much of it we can offset through pricing, we will see. Then on top of it, want to look at cost outs in the areas of warranties, ex-work costs, VMEs, better mix, the whole works. So we are looking at it comprehensively, and given our track record of delivery on cost agenda, we are quite confident that we will deliver the plans that we are putting together. How does the overall number balance because of this? I think you'll need to give us time till June 16th when we have the investor day. When we are able to tie this all together is our expectation. Hopefully by the time we'll have clarity. Sorry for a long answer, but hopefully that wraps up the entirety of the issue.
No, of course, that was indeed an important point. I'd like to ask you also about the kind of impact that you're already seeing as a result of the tariffs that have been imposed by the United States, the tariff situation in Europe as well, because of US-Europe tariffs right now, the kind of tariffs that Donald Trump has imposed. For the UK, for the Europe market, and for China, the immediate impact that you're seeing right now?
We are not seeing any impact at this point in time. The first impact will be felt in the US, because that's where the cost is going to go up. And so far, we are not seeing impact. I suspect that's our reading as well, is the premium luxury segment, which is where we are playing, is relatively more resilient to these cost increases, price increases compared to other segments of the market. But at the same time, we need to be respectful of the customers as well. So that is the balance we want to strike.
All right. We're going to take a short break, but this interview, this conversation with Mr. Balaji, the CFO of Tata Motors, continues on the other side. Welcome back. You're watching CNBC-TV18, and we are in conversation with PB Balaji, the Chief Financial Officer of Tata Motors, on the company's Q4 performance and the outlook for FY26. India-UK deal, that has been welcomed by many. How does this improve your outlook for JLR in India?
Yeah, it's a deal that we welcome, and I think it's a very good deal for JLR, but it will play out over a period of time. As far as the immediate impact is concerned, there's no impact, because if you look at the Range Rover portfolio, all of them are localized here in India through a CKD operation. And Defender, which we import, comes out of Slovakia, that is Europe. So that's not impacted by this FTA. So some of the questions which we are getting in the analyst call yesterday in terms of pricing in the market, etc., no change as far as the existing setup is concerned. Where it starts becoming interesting is the new products that will be generated in the future. Our ability to therefore access these at global prices is going to be far more in this kind of an FTA environment. At the same time, we also have to see the reverse from India to UK. What are the final structures that is coming in? I can see, for example, let's say the Agratas batteries. Is there an opportunity there? Is there opportunities for Indian cars to go there? Those are things we need to see. But in all this, again, similar to the UK situation, there is the fine print is awaited. And we need to know by when this is going to be implemented. What are the quotas that are going to be put in place? How does the arc go from 100 to 10% that people have said by 2030? What are the kind of time frames? How fast, how steep is it? So a lot of open questions at this point in time, but I think it's a matter of time before those clarity will be provided. So I will look forward to the details and the announcement notification of the tariffs under the FTA agreement. Until such time, we'll just have to wait and see. But no
Mr.
immediate
Balaji,
change on any front.
right. Mr. Balaji, we've signed a trade deal with the UK. The nitty-gritties are going to be worked out, but essentially it is a tariff of 10% that has been discussed. India will be imposing a tariff of 10% as opposed to 100% on fully built cars, and this will be for a fixed quota. We're looking to sign a FTA with Europe also, and it could be signed within the next few months. The US interim deal will also happen. Now, considering this environment right now, where India could strike 3 trade deals in a matter of months, does it make business sense for JLR to consider manufacturing electric vehicles in India for global markets? Is that something that you're weighing in strongly, perhaps in your new plant in Tamil Nadu?
All options are on the table. I think we always dynamically look at supply sources from all places. We will just have to wait for all the details to emerge, and these options then become whatever is the most sensible long-term option that is going to work out is what we will go for. And until such time those details come, all we can say is we'll remain open to all options. But before that, I can't comment anything because I don't know the detail.
Right. I would also like to ask you about the mood in China right now. US and China have agreed upon a trade deal, but China being JLR's one of JLR's biggest markets, how are things and how is the sentiment and outlook looking like?
I think China last year was a good year for us in terms of relative performance. Yes, absolute performance was weak, but relatively we have done much better than players there. And you'd notice that we are amongst the only few OEMs in the world which did not change our guidance and delivered on our guidance too in the last year. And that a lot of it is because the China market is something that we have managed exceedingly well, and learning from our lessons of the past, particularly 2019, where we did have a few challenges at that point in time. So those learnings are well embedded, and that is what we are leveraging in the current year as well. I think what we are seeing in China is there's a leveling off of the demand situation that was there. At the same time, VMEs are pretty high for some of the OEMs there. We have managed to keep it extremely tight. Our OEMs are our VMEs are half of what the other OEMs are currently running at. And we intend to keep it that way. So we would want to ensure the health of the network and the VMEs are kept low. And then whatever natural demand comes out, that is what we would want to work with. And that we're seeing that natural demand stabilizing. And therefore, we'll invest in the brand, ensuring that we gradually build that natural demand rather than worry about any supply chain noise in between us and the dealer network.
Right. My final 2 questions. On the commercial vehicle business, we're looking at a transition to new regulations for AC trucks that come into effect from the first week of June. What has been the expenditure that the company has to incur to make that transition?
For us, any regulatory change, we do not go with just that. We wrap this as a complete package for the customer, because we need to ensure that the TCO is well protected as the regulations kick in as well. And we believe that the product offering that we are putting together is compelling enough to ensure that the regulation is complied with. At the same time, we're also solving some of the inherent challenges that the fleet operator or the truck operator faces. So can't give you a direct number on that because we are not doing it as just a regulation. We are converting it into a full-fledged value-added offering. That's how we are looking at we've always done it for BS4, BS6, and that is what is giving us good results as well in the market performance.
Right. There is also a discussion on zero for zero tariffs in the FTA with the United States. Would you welcome zero tariffs in the automobile sector with the US market?
I think too early to say. It depends on what structure it is, because the cars that are made in the US that's a very different segment of cars and pickups that are there. So we'll need to see the individual details before we can comment. But conceptually, I think ensuring free trade flows both sides is something that we will always welcome.
Right. And finally, sir, on hybrid vehicles, many state governments, and most recently the Delhi government, has been weighing the same incentives on EVs as on hybrid vehicles. What would be your view on that? And considering that different state governments are looking at future policies and are considering hybrid as also a strong option when it comes to climate action, Are you looking to launch hybrid vehicles also in your portfolio in future?
I think firstly, we should be clear what is the need for an incentive. You incentivize stuff where there is a funding gap, and we are expecting technology to evolve and to meet that funding gap so that you ensure that you're not permanently funding something. That is the purpose of funding from a government perspective. Hybrids are decades old technology, and people make money on that. And there is nothing new that is coming through on that to be in a position to say there's a funding gap there. So conceptually, we do not agree to, and we do not understand both why any incentives have to be given on hybrids. People are supposed to sell hybrids for managing their own cafe compliance. So they don't need a carrot for that. They actually need a stick if they do not comply with it. Number one. Number two, with respect to our own launch of hybrids, nothing to do with incentives. It's more to do with what customer wants. And as I said earlier, it's a pretty well-established technology. In that situation, if tomorrow the customer believes that he wants to go into hybrids, then we are very much willing to offer the hybrids. But at this point in time, we do not see at the kind of low displacement engines that most of the portfolio of the country is. The case for a hybrid actually doesn't exist because two powertrains are more expensive than one powertrain. Whether there are other forms of hybrids that can help you drive EVs better, that's a different discussion. And in all this, the one thing that you also talked about emissions there. The one thing we should be careful about is that, and globally that is becoming a very important point as well, that people don't use the hybrid where it is supposed to be used, at least when the incentives were given. Invariably, the electric side of it stops. You invariably try to use it as a ICE engine only, in which case emissions don't go down. You're given away a tariff for a diesel engine or a petrol engine, which is not appropriate. So that's how we see this whole story. As long as it's the customer side of the conversation, we are more than happy to engage. If it's an incentive side of the conversation, we do not subscribe to it, and we believe whichever government is giving it is wasting its money.
All right. Thank you so much, Mr. Balaji, for joining us on the program, giving us your view on the growth drivers for Tata Motors and JLR for this financial year and some of the headwinds globally as well. Thanks once again for being with us.
Thank you. Thanks for having me on the show.
All right. That's all we have time for. Thank you for watching. Goodbye.